Hi, I'm Jenny Brown. Welcome to this week's edition of MFB News. I hope you are incredibly well and the last week has been really kind to you. In terms of what we've got for you this week, we're going to do our usual rundown on what's been happening in the lending space, talk a lot about what's happening with interest rates at the moment and really bring you up to speed on where things are currently sitting and give you some thoughts also for what's going to happen over the coming few weeks and months. We're then going to share some data that's been released from a landlord survey done on behalf of the Mortgage Works, which is going to go through rental income analysis and also tenant demand as well. So some really interesting reading to really give you a feel for how the broader rental market is holding up currently. Okay, so the lenders have been absolutely frenetic in terms of pricing changes, sadly going up rather than down. And I think it's really important before we get into what the lenders are doing is just to kind of talk a bit about what's happened with swap rates. So as of lunchtime today, and today is Tuesday, 2-year swap rates were at 5.050, 5-year swap rates 4.475, so still up on where they were 2 weeks ago. And this is really driving up lenders' cost of funds, which means they have no option but to reprice upwards to make sure that the numbers kind of still make sense for absolutely everybody involved in the mortgage chain. So what we did see a couple of weeks ago is one of two things happen. Lenders either simply repriced upwards, but another whole contingent of lenders stopped lending on fixed rates, and some stopped lending altogether and put a pause on that, but most of them withdrew all of their fixed rates from the market, citing that they were going to just let the capital market settle down, then they'll be back out with some new fixed rates. And actually the great news is that the vast majority of these lenders have now re-entered the market. There have been a couple who are yet to do so, but the majority of these lenders are now back out with fixed rate offerings. So I think the kind of key message here is that when the lenders paused lending on fixed rates, it wasn't because they simply don't want to, it's because they were just waiting for things to settle down. So who's come back in to rejoin us again after a little sabbatical? So we've seen Paragon first of all. Now Paragon are one of the lenders that we do the most amount of lending with because they are fantastic. So limited company borrowing, people, unlimited number of properties in the background, HMOs, multi-units up to 10 rooms or 10 self-contained units, day one remortgages, all this kind of stuff. So really good. And actually in their field, they tend to be incredibly competitively priced as well. So we really do enjoy working with Paragon as lenders. So when they pulled their fixed rates, we were just very glad to see them bring some new ones out, put it that way. So their 5-year pricing, so 5-year fixed rates from 5.35, 2-year fixed rates from 5.5%. Now I'm going to say at this juncture, what a lot of lenders are doing is saying that we're going to try and keep our interest rates down as low as we can because A, it impacts the rental calculations that we're using, which therefore can impact how much a borrower can access in terms of mortgage amount. But likewise, also psychologically, some borrowers are now becoming increasingly focused on cash flow. We're all feeling pretty stretched at the moment. So keeping down monthly payments is really important. So what lenders are often choosing to do is bring out these larger fee products, which I talked about for many weeks. And Paragon are no exception to that rule actually. So yes, 5.35 5-year fixed, but be prepared to pay a larger than you would normally expect to fee to benefit from what in the broader terms, and you'll see what I mean in a moment, is not a bad price at all. So Quantum back in the market, fixed rates on 5-year money from 6.6%, very specialist lender Quantum. Most of the specialist lenders are not sitting at that kind of level right now. Aldermore back in, so 5-year rates from 6.29, 2-year fixed rates from 6.39. Again, specialist lender. Aldermore are great at things like trading companies. I think that's probably where we do most of our business with them. So trading companies. So rather than being a company that simply buys buy-to-let properties and does nothing else, so just a rental company, Aldermore can lend to a business that does anything basically, but also wants to have a buy-to-let in it. The other thing Aldermore are quite good at is they do what's called portfolio lending. So one mortgage secured against multiple properties, and sometimes clients really do like these. So unfortunately their pricing feels a little bit inflated at the moment from 6.29, but it's great to have them back in the mix as well. Hampshire Trust, they've released their pricing now, so their residential offering is from 6.49 and semi-commercial is from 6.89. Residential, so Hampshire Trust, you would use them for complicated limited company structures, chunky HMOs, chunky multi-unit blocks. Semi-commercial, they're very good. So essentially, it generally is, a retail unit with some flats above. They're really good at that as well. We've seen Fleet Mortgages come back. That was great. We also use Fleet a huge amount. We have a great relationship with them. We find them incredibly reliable to work with, and pricing is very good. 5-year money, and actually incidentally their 2-year rates from 5.69, so no differential on pricing there. Fleet are not opting to use the high arrangement fee model, so they've gone for the slightly higher interest rate but with the lower arrangement fee compared to someone like Paragon, for example, who have gone in the reverse. We've also seen Capital Home Loans come back to market. Now, they haven't actually released any fixed rates, it's only variable, but they had put a total pause on lending, so it's great just to have them back in as well. Now, we've also seen lenders who didn't stop lending on fixed rates, who continued lending all the way through, having to reprice. And some have repriced once already and they're on their second round, and some have just held off and they've reached that point where they can't continue on the rates they're offering. So we had news today that Kent, Reliance and Precise Mortgages were withdrawing their rates at 5 o'clock today, Tuesday. So Wednesday morning, so tomorrow by the time you're watching this video, there'll be some shiny new rates out. We haven't been able to see those just yet. We've also heard word on the street that they're going to be withdrawing their refurb to let product and not reintroducing it at the moment, which is a real shame. It's fantastic. It will be back in due course, but just not right now. We've seen Vida do some repricing. Now, theirs is quite an interesting one. So they've put their rates up at circa 0.75% increase. So their 5-year rates are from 5.99%. Yeah, but what they have done is bring out a 1-year fixed rate. Now, I can see the point of one of these. If you're someone who's thinking interest rates are going to come down over the next 12 months, don't want to lock in for anything more than a year, or if actually you want to sell your property, but you don't want to do it right now because you think the housing market is probably feeling a little bit shaky, then maybe a 1-year fixed rate could be for you. Now, pricing here on their 1-year fixed rates are from 5.19%, arrangement fees circa 3%. So actually there is, one could argue, I mean, it's the 1-year interest rate is 8.19%, which is really expensive, but it could be a means to an end, I think is what I'm trying to say in a very long way. Now, Vida can lend to limited companies and individuals, no maximum number of properties in the background, no minimum income requirement. They can lend on ex-local authority flats, new builds, things above or next to commercial as well. So they've got a really, really broad offering. So it could be that actually a 1-year solution might be something which would work for some people. Incidentally, the Mortgage Works have also got a 1-year fixed rate out at the moment as well, which is not bad if that's what you're after. I mean, I don't think anyone would consciously buy into a 1-year fixed rate if they thought interest rates were going to go up. So I think this is really for those believers in interest rates coming down over the next 12 months. Now, Molo have released new rates. Their pricing is now from 5.59. It's a real shame actually, they'd really held off. They were looking incredibly competitive, but I think they just get to the point where numerically it stops making sense for them to lend at the rates that they had, and also probably getting absolutely bombarded with new cases. So they've given it up and they've put their pricing up. So now from 5.59, just to know they're still lending at 80% loan to value as well. There are lenders at 80% loan to value. It is still available. They do charge a bit more for it, but it is an option that's still there. YBS, Yorkshire Building Society, pricing there has moved up. Their fixed rates are now from 5.3. Wonderful, wonderful lender. Absolutely love working with them. Think larger, sort of chunkier buy-to-lets to higher values. Minimum loan tends to be about £500,000. So chunkier, limited company-owned properties, particularly larger HMOs and multi-units, they're really good at those. Landbay increased their rates. Gosh, that would be nice. They did it without any notice, which is frustrating as a broker. So most lenders will give us the courtesy of saying at 10 o'clock in the morning, you have until 5 o'clock tonight, so we have some fighting chance of trying to sort some of our, or help book some rates for some of our clients. Landbay, unfortunately, just pull their products. They don't give us any notice at all. Their pricing from 4.69, you know what I'm going to say, watch the arrangement fees. More vanilla lenders now, so Barclays have increased their rates by 1%. Their pricing is now from 5.6. We've seen Virgin make increases of 0.55, so their pricing is now from 4.6%. Our lovely friends at the West Brom have increased their rates, so 2-year rates are now from 5.74 and 5 years from 6.09. And we've seen the Coventry make increases there, so their pricing is now from 4.84%. So you kind of get the gist about what's been going on. And if I'm really honest, I can't see much changing over the next few weeks now. It feels like we're kind of really stuck. I think we need to get the inflation figures out. We need to get the base rate increase out of the way, and then hopefully we'll start to see things maybe calm down a bit. But at the moment, the markets are just so incredibly fragile and jittery. So I think, you know, for those people who are in need of a mortgage quite urgently, this is kind of where the rates are. The other thing just to kind of say, and I say this often, but there is a school of thought that actually interest rates could continue to go up. Now, I'm not Mystic Meg, I don't have all the answers. Common sense sort of tells me that I think we will see things start to come down, hopefully, later on this month. However, it could be that something else happens. So, for example, with the oil, there might be some kind of news or fallout with the situation in Ukraine. We just don't know. So it could be that actually rates actually continue to increase. So if that's the side of the fence that you sit on and you are concerned, something really worth knowing is that most lenders, if you make an application with them on today's rate, if they drop their pricing down, as long as you haven't completed, a large chunk of them will actually let you move on to the new lower interest rate. Generally, they don't charge you for this. If they do charge you, it's normally a small admin fee of like £150. So it could be that actually taking a rate now, you might not like it, but at least you've got something, and then being able to review things nearer the time and seeing if you can better it could be a really good option for you. I think at the moment, in all this uncertainty, we all look for moments of certainty and security as well. Okay, let's talk about something slightly more cheerful now, by way of rental incomes. So this may actually help some way to help counter the increased borrowing costs, because rental income is on the increase. And we've talked about this many times, but the Mortgage Works go out and do a really big survey of lots and lots of landlords across the whole of the UK to find out what they're experiencing with their letting business. And the results are always really interesting because this is directly from landlords now. And so what they do is they kind of compile this data, and we've got two reports to go through today. And the first one is rental income, the second one is the tenant demand report, which is also really good. So first of all, touching on rental income. So lots of interesting statistics. So first of all, the average annual rent per property across all of the respondents means that the average property in the UK is now letting at £9,252 per year, which is an increase. 63% of landlords who responded had increased their rents in the last 12 months, and 52% are planning to increase in the next 6 months as well. So lots of movement on rental income there. Now, in terms of yields, we've got some interesting data in terms of regionally which areas are producing the highest and lowest levels. So the Northwest continues to have the top spot in terms of rental yield at 6.1%. West Midlands follows at 5.7%, and Southwest of England is 5.6%. And then also you imagine there's a whole bunch of regions in the middle, and then the bottom three. So third from bottom, the Southeast, which is 4.6%. Of course, that's where my buy-to-let would be, or both of them actually. I suppose, I'd be glad to get 4.6% because that would mean that I had a tenant that was actually paying their rent. Outer London, 4.4%, and Central London is at 4%. So you can see how the yields vary quite dramatically. By property type, average yields. So HMO's average yield here is 6%. I don't know that I see that. I recognise that number. We see clients who are generating far higher yields on their HMOs, but this is what the respondents to this particular survey report. And I suppose if they're going out to existing borrowers, the Mortgage Works only ever lend on HMOs of, sort of up to 6 bedrooms, so not the really large, high yielding ones. So maybe that's got something to do with it. But according to these guys, 6% is your average yield on an HMO. Block of flats, 5.6%, a detached house, and a terraced house, and a semi-detached house. In fact, all houses, 5.3%. Flats, individual units, and one self-contained flat, you'd get an average yield of 5%, and the same is with a bungalow. So actually it feels to me like those yields are starting to compress and get a little bit closer. So that's kind of interesting from the rental income analysis. It's really good to see that people are looking or experiencing rents increasing. I think that's really important. And obviously we don't want to price tenants out of the market. We don't want to kind of put them under financial difficulty, but actually likewise, I think everybody's facing increased costs at the moment. And so if we can put our rents up a bit just to kind of help manage that, that's only going to be, a good thing. Okay, and now moving on to tenant demand. So equally a positive news story there. As landlords, you want your properties to be in demand because that means that you can relet them, and obviously this helps underpin rental income, at least stability and also growth as well. So first of all, of the respondents who came back to this survey, 67% of landlords reported that tenant demand had either increased significantly or slightly, countered by just 4% who said that tenant demand had either decreased slightly or significantly. So really just showing that the respondents to this survey are finding that things are still doing incredibly well in that regard. Now regionally, who's doing the best? So actually demand from tenants in central London is strongest across the whole country. This is followed by the east of England and then by Yorkshire and the Humber. The areas which are experiencing the weakest level of tenant demand, and that's not to say there is no demand, it's just less than the others, would be the West Midlands, Wales and the East Midlands as well. So I think actually, you know, despite delivering all this kind of news around interest rates, I do generally think that as landlords, your mortgage costs are just one piece of a very, very big jigsaw puzzle, and actually knowing that you have you know, a demand for your buy-to-let property, that your rents are going to be sustainable and actually probably go up. They don't have to go up by crazy amounts, but going up a bit is also really helpful as well. As we face increased costs across the board, there is actually some real positivity to be had from this. And that's everything for me this week. Thank you, as always, for joining me. I hope to be back with some really great news next week. Like I said, I don't see much changing between now and base rate going up later on this month. I say it with such certainty, don't I? Maybe I'll be proved wrong, but you know, there is very much a almost unanimous opinion that we're going to see a 25% increase later on this month. So brace yourselves for that indeed. Incidentally, we are still getting borrowers who are calling us up saying, you know, I went on to standard variable rate months ago. I really thought interest rates would kind of go up a bit and then start coming back down. They haven't, they've gone the other way. Can I now look to remortgage? And some standard variable rates, I mean, they do range from sort of like circa 8% to sort of over 11%. So if you are in that situation, it's not too late to save yourself some money. You know, please just get yourself off of these variable rates because they are really high. And actually the expectation, the longer term view on base rate, there is still a thought it will come down, but it's now been sort of kicked down the road. So, you know, maybe by the end of H1 next year is where you're looking at. So that's a really long time. That's another 12 months to be sat on those very, very high interest rates, which will go up again. So please don't do that. Anyway, lecture over. Have a great weekend. If you need us for anything, 0345 345 6788. As always, oodles of information on our website. Have a great weekend, and I'll see you again same time next week.